As we've been discussing for years, a wealth of academic and independent professional research exists showing the steep odds that active investors face in outperforming over time their representative indexes. Still, a few contrarians argue against such logic. The problem as they see it is diversification. Instead of spreading their bets, some advisors argue that investors need to pick fund managers who run only with very, very concentrated portfolios. The reasoning is that by investing with less diversification, these sage speculators can focus on putting more of their bets on stocks they think will prove to be the biggest winners. To explain such logic, or maybe to caution against it, is Craig Lazzara, Managing Director at S&P Dow Jones Indices. Hi, Craig. Thanks for being with us today.
Great to see you again. Thank you.
You betcha. Of course, such speculation runs counter to modern portfolio theory and arguably common sense. What's behind such thinking?
Well, the idea that to summarize the idea, if I may, just the idea is that the problem with active management, the reason that most active managers underperform objective benchmarks like the S&P 500 is that they are not active enough. If only they were more active, their performance would improve, or that's what the assertion is. And it's on the surface a plausible assertion, because if you think about, let's say, again, benchmark against the S&P 500, if I simply own the 500 stocks in the S&P 500 in cap weights, there's no chance whatever that I'm going to outperform. So in order to have even a chance of outperforming, I have to increase my aggressiveness. Some people measure that by active share, the share of my portfolio that does not look like my benchmark. And so given that a certain amount of active share is a necessary prerequisite to outperformance, some people like to make the leap and say, well, it's not only necessary, it's sufficient, and it's not sufficient. And there are a number of reasons for that.
Well, isn't risk management a key part of diversification?
That is one of the reasons, yes, is that you will end up with if you concentrate, you'll have a more volatile portfolio than a less concentrated portfolio. So yes, that is certainly the case. But the active school would argue, well, it's worth having a little more risk if you can be rewarded in terms of return. That's, as I say, it's a plausible argument. I think here are the things that I think are wrong with the argument. First, it assumes something about the level of a manager's skill, which is simply not backed up by the data. In other words, if you believe that the problem with active management is that it's not active enough, that implies that for a manager, say, who normally runs a 50 or 60 stock portfolio, what does he have to do to be more aggressive? Well, he has to have maybe a 10 or 15 stock portfolio. That assumes not only is his forecasting ability enough to identify 50 or 60 stocks that will outperform from among all those that are available to him, he'll have to be able to say which of the 50 or 60 are the best 10 or the best dozen. That requires a level of skill that the statistics suggest simply doesn't exist, because if managers had that level of skill, most of them wouldn't underperform benchmarks in the first place. So that's the first thing that I think is wrong with the argument.
Okay.
The second thing has to do with the nature of stock returns. I think we've talked about this before. Stock returns are what a statistician would call skewed to the right. In other words, a stock can only go down 100%. It can go up 100, 200, 300. So if you look at the distribution of returns over time, you see this long right tail. And way at the end of the right tail are the famous names like Amazon and Apple that we all know about because they've done very, very well. Well, what skewed returns mean is that the average stock outperforms the median. In other words, more than half of the distribution is below the level of performance achieved by the average stock. We did a study not long ago for the S&P 500 over a 20-year period. I think only 25 or 24% of the members of the S&P 500 outperformed the performance of the average stock because the average is pulled up by some of the very largest winners. Now, what that implies is that over a reasonably long period of time, success as a portfolio manager or as an investor is going to be driven by whether you have access or whether you have positions in one of a relatively small number of big outperformers. The larger your portfolio is, the better the odds that you will own at least one of this relatively small group of stocks. If you have a more concentrated portfolio, you're less likely to stumble upon one of the big winners, which means that you're more likely to underperform with a concentrated portfolio than you are to outperform. So that's the second thing. And the third thing has to do with the nature of skill and luck, for lack of a better way to categorize it. I'll put the example this way: if we go into a casino, I'm not an expert casino player, but let's say we go up to the roulette table, we put money on red. You have almost a 50% chance of winning if you put your money on red or put it on black, for that matter. So you might very well win once, you might win twice. You spin 100 times on red, you're going to lose your money. The casino has a relatively small edge, but the edge piles up over time. If I win on in the first spin of the wheel, that is purely a function of luck. One of the things that's quite clear, not just in investments, it's true in casinos, it's true. I've written about my fantasy basketball game of shooting foul shots with Michael Jordan. Luck dissipates, skill persists. And so if I am a portfolio manager and I think I'm skillful at picking stocks, I want to have a very wide range of stocks to demonstrate my skill, because then the true skill that I possess is more likely to show up. If I'm allowed to pick, say, out of the S&P 500, 50 stocks, and I'm good at picking stocks, I probably will have a portfolio that outperforms. If I'm good at picking stocks, but I only am allowed to pick 10 or 12 stocks, it's more likely that one of them is going to be unlucky for me. So as you increase, just as with the casino example, you increase exposure to luck over time. In the case of stock selection, you're increasing exposure to skill by having a wider number of names. And those are the reasons that I think that it is the idea that concentrated portfolios are more likely to outperform, although it's plausible and attractive on its surface, is fundamentally incorrect.
Yeah, and you mean it's plausible over short periods?
It's plausible over, well, it's plausible. I mean, I think it's incorrect over short or long periods, but it's certainly plausible over short periods. And if one could do it over short periods, it's plausible to suppose those periods could be extended. But I think the skewness argument is particularly acute over long periods of time. So I think to that degree, you're right, Murray. It's more likely even more likely to prove wrong over long periods than over short.
And also, for a fund investor, the added costs of trading a lot more regularly has to add up.
Oh, absolutely. Even if you're as an investor concerned to minimize trading costs, the amount you trade obviously has a big impact on your costs, but your costs quite often depend on how much of a stock's volume you want to transact in. If I'm a large portfolio manager, but I have 100 stock portfolio, each of my trades is of a certain size. If I have a 10 stock portfolio, each of my trades is 10 times bigger. And so the cost of transacting with bigger positions is likely to be higher.
Sure. Okay. So either way, it just doesn't make any sense, does it? From a statistical and objective point of view.
I think from an objective standpoint, it does not. I mean, I would say about the notion of concentrated portfolios, the same thing I say about active portfolios generally. Investors who choose active portfolios or investors who choose concentrated active portfolios should recognize that the odds are against them. If you recognize that and still want to try it, not my place to tell you you can't. But recognize that what the odds are.
Yeah. Thank you very much, Craig.
Thank you, Murray.